Hey everyone, welcome back to Corporate Decoder, the place where we decode the often confusing language of corporate filings. Today we're diving into a report from the Federal Home Loan Bank of Cincinnati, and trust me, it's more exciting than it sounds because this report is all about where they're getting their money. We'll be looking at some of their debt and financial moves. Think of it as trying to understand how a bank balances its checkbook, but on a much larger scale. Let's get started. This report is a Form 8K, which companies file to announce major events that could be important to investors. In this case, it's about creating financial obligations, basically taking on debt. The Federal Home Loan Bank of Cincinnati, or FHLB, is like a bank for banks. It provides money to other banks so they can make loans to people and businesses in their communities. It's part of a system of 11 federal home loan banks across the United States. The FHLB gets most of its money by selling debt securities called consolidated obligations. These are like bonds where investors lend money to the FHLB and the FHLB promises to pay them back with interest. All 11 federal home loan banks are responsible for these obligations. So if one bank has trouble paying, the others step in. Think of it like a group of friends co-signing a loan. Everyone is responsible if one person can't pay. These aren't backed by the US government. Let's talk about Schedule A in this report. It's like a list of all the bonds the FHLB has promised to issue, where the FHLB is primarily responsible for paying back the debt. So it gives a snapshot of where the FHLB stands financially. The details in Schedule A don't include the super short-term debt they take on or any secret deals they make using what are called derivative instruments. It also won't tell you if they are using the money to pay off debts they already have. The report also warns us that the numbers on Schedule A are just the face value of the bonds, not necessarily what they'd look like on their official financial statements. Also won't tell you if they are using the money to pay off debts they already have for derivative instruments. It also won't tell you if they are using the money to pay off debts they already have. The report also warns us that the numbers on Schedule A are just the face value of the bonds, not necessarily what they'd look like on their official financial statements. Also, this schedule doesn't include bonds that other federal home loan banks are responsible for. Now let's dive into the numbers. On April 7th of this year, the FHLB committed to issuing a bond with the CUSIP number 35FET number 3130B5UL0AC USEP. Number 3130B5UL Luron ACU's IP number is like a serial number for financial securities. The bond is set to mature or be paid back on September 11th of this year. The next interest payment is due on June 11th of this year. This bond is non-teller, which means the FHLB can't pay it off early. It's a variable single index floater, meaning the interest rate changes based on a single index, like a benchmark interest rate. The total amount of this bond is $506.7 million. On the same day, April 7th, they also committed to another bond, CUSIP number 3039. This one matures on October 14th of this year, with the next pay date being July 14th of this year, with the next pay date being July 14th of this year. It's also non-callable and a variable single index floater. This bond is for $5. Bond is for $600 million, 14th of this year, with the next pay date being July 14th of this year. It's also non-callable and a variable single index floater. This bond is for $600 million. The report also includes definitions for some of the terms used in Schedule A. For instance, optional principal redemption bonds are bonds that the FHLB can choose to pay off early. Variable bonds are bonds where the interest rate can change over time. This is as opposed to fixed bonds where the interest rate stays the same. Finally, single index floater bonds pay interest that rises and falls with a specific index, like a benchmark interest rate. Actor now, let's step back and look at the bigger picture. What does all this mean? The FHLB is basically borrowing a lot of money, over $1 billion. The amounts may sound big, but these banks move massive amounts of money every day. It's important to keep an eye on how they are managing their debt. The FHLB is trying to provide loans to banks, which in turn help communities. If the FHLB can't manage its debt, it could have a ripple effect, making it harder for people and businesses to get the loans they need. This report was signed by Alison D. Kieft, First Vice President, Assistant Controller. This signature shows that the FHLB stands behind the accuracy of the information in the report. So to sum it up, this report gives us a peek into how the Federal Home Loan Bank of Cincinnati is funding its operations. By issuing these bonds, the FHLB is raising the capital it needs to support banks and communities. This report doesn't give you a picture of the financials of FHLB overall, so we can't really judge much about their health. Thanks for watching Corporate Decoder. If you found this video helpful, please like, comment and subscribe for more insights into the world of corporate filings.